welcome to Investment Matters with Peter Kinch, Diversify Alternative Investments today. And today I'm absolutely thrilled to have John Courtliff here with me from ICM. John is the Managing Director and Portfolio Manager for ICM. John, it's great to have you on our program today.
Yeah, thanks, Peter. Appreciate being here.
You know, a lot of people are familiar with REITs or mortgage investment corporations and whatnot. ICM is a little different, and not everybody's familiar. Maybe some people who are listening to this have not heard of ICM. I want to share some of the numbers because they're quite fascinating. First of all, ICM was originally founded by or started by Bruce Timm. It has an 18-year track record coupled with assets under management of over $1.2 billion. I'm sure that number is a little bit higher now, but that encompasses 12 different funds that have been launched since your inception. And you paid out over $183 million in distributions to over 5,000 clients over that time frame. So pretty impressive stats, pretty impressive numbers. But again, people might be lost. Who's ICM? What do you do? Maybe before we dive into the details, John, give me a little background about how ICM got started and how you kind of evolved to the point you're at today.
Sure. Well, as you mentioned, Bruce started ICM in 2003, and the company has really grown since. It was initially a small sort of family office real estate investment manager, and in 2011, a couple of us joined, Spencer Patton and myself, and we've added another few partners along the way as well. And now, the firm is 4.5, 5 times the size that it was when I first joined in 2011. It's hard to believe I've been here over a decade already, but no, it's grown quickly. It's grown substantially, and the platform is continuing to grow. We're a real estate investment platform. So unlike a REIT, which traditionally sort of buys assets and holds those assets indefinitely, we monetize our investments and actually trade out of projects or properties as we feel that there's an opportunity for us to do so and redeploy those net proceeds in a more profitable manner. So we are quite different than a REIT in that sense, where we do look to actively turn through the portfolio and realize gains for investors and redeploy that capital.
John, I know historically, and in fact, some of the people listening to this interview today would have been invested in projects like ICM 7, ICM 9. You used to have numbers behind your projects or funds, if you will. And correct me if I'm wrong, but the model was basically you raise some capital, a specific targeted number or amount of capital, and then you target a specific asset class, be it office buildings or a specific type of commercial assets that you're purchasing. And then that ties up one fund and it's kind of closed off. You do a kind of a buy, fix, and flip on a much grander scale. Then you liquidate the assets and the investor sees a return on that investment. That was the traditional model. You've since transitioned, and now we have the Property Partners Trust. It's ICM PPT. Tell us a little bit about why you transit. First of all, what is Property Partners Trust? How is it different than the previous model? And what are some of the reasons you guys transitioned to that model?
Yeah, I mean, ultimately, it was a better fit for the investor profile that we're investing in our closed-end funds, and we believe that because ultimately, an investor's need for liquidity is going to vary greatly by investor, and ICM Property Partners Trust allows people to invest and redeem out to create liquidity for themselves at any given point in time thereafter. And what that means ultimately is that the gains that we realize on projects along the way are embedded in the underlying value of the units of the trust that investors hold. So when they redeem out, they eventually realize the gains that they've achieved. Obviously, there's a distribution paid in the meantime as well. Where historically what we employed were more closed-end funds, which, as you suggested, we raised a defined pool of capital, deployed it, and as soon as we liquidated assets within that portfolio, we would return that capital to the investors. So that model put us more on a treadmill, if you will, where we're continually having to trade out of assets, return proceeds to investors, raise new capital before we're able to identify and invest in new opportunities. This open-ended structure that is Property Partners Trust is much more flexible in that context and allows us to better position investors over time for success.
Yeah, and I also noticed there's a bit of a shift in the makeup of the fund as well. Whereas before you might have focused on, I know, like for ICM7, for example, was specifically commercial office space. Now there's three key components to, or strategies, if you will, to Property Partners Trust. One is income and growth. The other is development, and the other is high yield lending. I'd like you to speak to that in terms of how that works with each of those different categories, because again, it's not just one thing. You're not just buying apartment buildings or office buildings or lending on mortgages. You're doing three different strategies. So tell us a little bit about maybe the percentage breakdown on that within the fund, and some of the thought process behind why you went in that direction.
Well, I mean, really, it's we have the ability to invest along the capital stack in real estate and across different property types as well. And we believe that that's of benefit ultimately to investors because we've been doing this a long time. And retail investors, notoriously end up being the last invested in what are the next great opportunities by virtue of the structures that they have available to them through which they invest. And what Property Partners Trust seeks to do is to pool the capital of those investors and allow us the flexibility to identify where we feel the next great opportunities are in real estate. So we shifted a couple of years ago to industrial and industrial development, most specifically. And we'd spent a good year building a pipeline of opportunity before the pandemic hit. And that's allowed us to add a significant amount of industrial to the portfolio in the last 12 to 15 months, where previously it would have taken us, 12 to 15 months to make a first investment if we'd only shifted post-pandemic. But that's where the opportunity was in our minds pre-COVID, and it's become immensely clear to anybody following real estate that industrial has been where the opportunity has been, and it's become even more pronounced than it was when we first began focusing on the space. So, we feel that the Property Partners Trust structure is a valuable one for investors because it allows us to transition the portfolio over time and continually evolve where we're investing to try to capitalize on the best opportunities in market.
Yeah, I can see that. And also, you talked about industrial. I'm going to circle back to that. One of the other key components here is geographical distribution. It's not just a Canadian fund. I got to get back to that. Before we do, one of the things I always like to do is I like to break down investments like this for the average individual who's listening. And as somebody who's sitting there, okay, well, if I threw my money in there, what happens to it? So I'm going to ask you a question, just Ed, if you could just break this down in layman's terms, maybe give me an example. If an individual investor were to put $50,000 into Property Partners Trust, where would that money be allocated? And can you walk me through how the investor gets a return?
Sure. So you mentioned geography as well as property type and the like. So an investor's dollar right now would be allocated about 63 cents to the US, about 28 cents to Mexico, and the remainder would be invested in Canada. So Canada makes up the smallest allocation in Property Partners Trust, and that's by design. We've simply seen better opportunity south of the border over the last number of years. Similarly, about a little over 30% of the portfolio now is invested in industrial property. Likewise, just a little over 30% is invested in office property, which is predominantly suburban, low-rise office properties in the US. And about 20% of the portfolio is invested in residential property. So either condos under construction or multifamily properties that are rented. And the balance is invested in either mixed use, retail or hospitality properties. So quite a small portion there.
There's definitely some development component here and some longer term strategies. So again, getting back, if somebody asked me, okay, Peter, well, what should my expectations be if I were to take, again, I'll use the example of if an investor said, here's 50 grand. what would you say to that individual in terms of managing their expectations, in terms of what they should expect in terms of monthly or annual cash distributions versus growth? And what kind of timeline should an investor look at for this type of investment?
Yeah, so an investor can expect that their distributions will be 5 to 6% of their invested capital on an annual basis, and we expect to have some growth on top of that. So a total investor return of 8 to 9% is a reasonable total target, and that's achieved through not only the distributions but over time growth in the underlying value of the properties that the fund holds, and investors realize that that latter portion of return, 5 to 7 years after they've made their initial investment upon redeeming out of the fund.
So again, this is not a quick in and out like a mutual fund. This is if you make this investment, you should be looking at a 5 to 7 year timeline.
That's right. I mean, there are costs on the front end of the investment that need to be amortized, and we only get the net capital to deploy, and it takes us a while to recover those costs of making that investment for the investor, and it does take a full investment term, if you will, to not only recover those costs but to deliver the return for investors.
Yeah, that's so important for investors to understand. I often will use the comparison that if you're in an apartment REIT, for example, that's like going out and buying an existing building that has tenants and cash flow today versus I'm looking out my window right now and I got a pre-sale. I bought a pre-sale next door. And I can see the cranes up there. They've been up there for over a year and a half. So if you buy it into a development, it first goes back. It almost goes backwards at first, right? Because you got to dig a hole in the ground before you can see it built, filled, and have tenants start paying the rent. So that makes sense. One of the things that's really important, I think, that you touched on is geography. Now, I would say that upwards of 90% of this fund is outside of Canada. And I think that's really important because a lot of investors, Canadian investors, often when it comes to alternative assets that are not stocks, bonds, and mutual funds, which is the category you would fit into, a lot of those investments are Canadian focused, which is fine. But tell me why you think, from your perspective as a portfolio manager, there's a huge advantage at looking outside of Canada as a way of supplementing other investments you might have and adding additional diversification.
I mean, I think the last word you said there hits the nail on the head. It's diversification. As you said, a lot of Canadian investors are, hyper focused with their portfolios on investments within Canada, and lack exposure to other markets. So that certainly is something that we provide and always will, despite having the flexibility to invest across North America. We always expect that the vast majority of the portfolio will be invested outside of Canada. Right now, the skew is largely a result of where we found opportunity over the last number of years, and we continue to believe that our investment dollars are better placed south of the border. The investments that we're seeing in markets like Phoenix and Dallas and Atlanta are simply more compelling than those that we're seeing in Canada by and large. So it doesn't mean that we're not investing in Canada, but it means that on a larger scale, we're seeing more and better quality opportunities south of the border.
Yeah, and a term I've heard you use before is risk-adjusted opportunities. And I've heard others say that they're finding greater risk-adjusted opportunities outside of Canada, and especially in some of the cities you mentioned, and including Mexico, which might be surprising. Tell us a little bit. I know some investors, when they hear the term that you're investing in Mexico or that they're put money into a fund that's going into Mexico, might get nervous about that and say, that's a little, Phoenix is one thing, Mexico is another. Okay. So tell me a little bit about the logic behind making that and identifying risk-adjusted opportunities south of the border, both US and Mexico.
Yeah, I mean, Mexico is a fascinating market and one that we see a lot of upside in over the long term. It's anticipated that by 2050, Mexico will be the 7th largest economy in the world. It's an incredibly young population, and that inherently supports long-term economic growth. And being a part of the USMCA, previously NAFTA, gives Mexico a big leg up, if you will, in terms of its potential growth as well. So the economy's performed reasonably well over the last number of years. It's the U.S.'s largest trading partner, and particularly right now with our focus on industrial. Mexico is a strong manufacturing market for ultimately products that are distributed across the U.S. So we are very bullish on Mexico. It's not like we're down there, buying timeshares, which would be what a lot of investors would associate with Mexico. But where we're investing is not on the coastlines. I mean, we're not in those resort properties. We're in Mexico City. We're in Guadalajara and Monterrey and Tijuana. These are ultimately the growth centers and the growth engines of the Mexican economy.
Well, I mean, you said something that's really important there is industrial space, and there's terms like offshoring, onshoring. That PricewaterhouseCoopers and the Urban Land Institute just produced a report called the 2022 Emerging Trends in Real Estate. And by the way, if anybody wants that 122-page report, you can send me an email. I'll be happy to forward that to you. But there was a few key things that came out of that report that I made a note of, and one was it talks about the industrial distribution is the top sector for investors and developers. ICM has made a significant shift over the past 2 to 3 years to focus more of their new investment activity towards industrial buildings, which include logistics, warehousing, and distribution. I am fascinated by this, especially in a post-pandemic era here that we're kind of on. I'm optimistically calling it post-pandemic, but in a COVID era, time that we live in, can you speak to that? And obviously, you're not the only ones that see the opportunity there. Tell us more about your industrial, the shift towards that.
Sure. In fact, we're one of the investors quoted in that report. So no surprise to us that other investors are finding an opportunity in the same areas that we are. It's the trend towards industrial and the growth in the demand for industrial space in the US and even in Mexico really predates COVID. COVID was an accelerant for a couple of trends that were already driving the demand for industrial space. The first is no surprise to anybody. E-commerce has become a more and more prevalent force in retail spending. And what we saw through COVID was that people who had never made a purchase online suddenly began shopping online. And I think of my parents who had never bought anything online, and then COVID hit and they started ordering things to their door. So not all of that demand will return to bricks and mortar retail, and we see a permanent gapping higher in e-commerce spending, and that e-commerce will then begin to grow from its newer higher basis now. And if that was driving demand for industrial space for distribution and logistics across the U.S. pre-pandemic, COVID only accelerated that demand and not only pulled a lot of it forward, but ultimately means that there's going to be greater demand than there was pre-COVID. So, JLL also estimate that by 2025 there'll be a need for an additional 1 billion square feet of real estate or industrial real estate in the U.S. for distribution and logistics alone. So, that ultimately is a trend that we're trying to be a part of and to profit from. And we've made a number of investments in distribution and logistics facilities in the U.S. And continue to see that as a great opportunity for the next few years. The story in Mexico is a little bit different in the sense that not only is distribution and logistics an important part of the industrial landscape down there, but much more so than in Canada and in the U.S. Manufacturing is an incredibly important part of the industrial landscape in Mexico, and what is sold into the U.S. and distributed out of those distribution and logistics warehouses across the Southeast U.S. and into the western parts of the U.S. as well is often made in Mexico, and ultimately we see a great opportunity to invest in the growing number of companies that are seeking to not only relocate but diversify their supply chains from Southeast Asia and including manufacturing in markets that are closer to the end customer. So I mentioned before the benefit, if you will, of NAFTA and now USMCA to the Mexican economy. and it makes Mexico a very attractive manufacturing jurisdiction for American companies or any companies looking to sell product into the U.S. So it's a growing market. It's grown more quickly over the last 15 to 18 months than in the last few years. Even though the last few years it's been reasonably strong. So again, two real trends that we're trying to be a part of.
Wow. There's a lot there to unpackage, so to speak, because is more than some of the preconceived notions that people have, whether it's resort towns or your only exposure to Mexico is having watched Narcos on TV. I think one of the other things that's really important that you mentioned is in the state. I think you said there was 1 billion. Was it 1 billion square feet that they need of new industrial space? Like that's huge. That's major. And so what I like about what you guys are doing is you're ahead of the curve, so to speak, on a lot of that. You've been involved for 2 to 3 years, getting involved in the industrial space down there. One of the things that I think is important is looking at this and how Mexico is playing a role in manufacturing. Obviously, with COVID, the biggest thing we saw from COVID was disruption in distribution distribution chains. And let's face it, most of that out of China. And I think North America has developed a sense of not wanting to become dependent on some of those sources out of Asia and realizing the danger of having a heavy dependence there. Would you say that's played into this a lot as well?
It has. There's a number of terms that have been bandied about the last couple of years, and it began with reshoring and nearshoring, and then friendshoring, and then ally shoring, and all these terms. But ultimately, they all mean generally the same thing, and that means that that the production of the goods that we consume is being brought closer to home, and it doesn't necessarily, as I said earlier, mean that supply chains are being relocated in their entirety, but it means that those supply chains are being diversified to build resiliency. So, for the last 2 decades, we've been in a world that has been hyper-focused on just-in-time inventory systems and effectively providing consumers with products, on a whim and without inventory being built up in any company's system. And the last 18 months has made everybody realize that just-in-time inventory is great until it's not great. And then suddenly you've got issues about being able to continue to supply your consumers. So there's been a lot more focus on building resiliency within supply chains, and that's shifting, if you will, the demand for industrial and bringing some of it closer to home.
Now, we touched on COVID, we touched on the pandemic, et cetera. When this all started, we take you back to March 2020. You remember those dark days when everybody was freaking out and concerned about how this was all going to play out. One of the concerns I had, ICM wasn't the only player in the field that may have been impacted by this. I think every investment company that worked in your area was worried about how that pandemic was going to affect their investment and their investors. So you guys also have a component of your business, which is office space, with people leaving offices, working from home. Tell me a little bit about, what were some of your concerns? What were you afraid about back in March 2020? And then tell me what actually happened.
Yeah, it was a pretty interesting time, certainly a source of a lot of gray hair. I've got my patch right here, but it was stressful. It was immensely stressful because there was so much uncertainty. And in the investment world, we measure risk with uncertainty. And at the time, we didn't know what was going to unfold. We didn't know, whether this was going to be a relatively short-lived event or whether it was going to be massively impactful for decades to come. And I think that we've certainly got a lot more clarity on that over the last 18 months. But in the spring and into the summer of 2020, there was a risk within our own portfolio that people simply weren't going to return to the office, and that tenants were going to go bankrupt, that businesses were going to fail. And it wasn't so much people being in the office, it's the company's ability to pay rent and maintain or keep that office space for the eventual return. And we didn't know how that was going to unfold. So we spent the next few months certainly assessing every tenant in our portfolio and re-underwriting every business and assigning risk factors to sectors that those businesses were a part of, and so on. And through the summer of 2020 and into the fall, we collected 97% of rent from our office portfolio, and that was in part, across the board, but I think that our portfolio outperformed the broader office market in the U.S. certainly. And that's in no small part a function of the fact that I mentioned at the outset that the office properties that we do hold across the U.S. are in strong markets, for one, but secondly, they're largely low-rise suburban office markets and office properties as well. So you don't have the challenges of the tall downtown office properties and getting people into those properties. I mean, more than 50% of the value of the assets we hold in the office space were in single-story flex office built business parks. So, much easier for people to drive to their parking spot, get out of their car, and walk in the front door of their business than to try to cram into an elevator and get up to the 42nd floor. So, from an operational perspective, much less impactful. The companies were far more resilient than I think that we anticipated going into COVID, and rent collection ended up being much, much stronger. So from a pricing perspective, office properties haven't bounced back as fast as apartment buildings or industrial properties, but we are seeing positive leasing activity across our portfolio. So we believe that through the rest of this year and into next, office properties will continue to perform.
And a lot of those properties were previously might have been in ICM 7 or ICM 9, previous funds that some of our clients were invested in, and those were kind of folded into Property Partners Trust as a way of giving those previous investors who were singularly exposed to office, for example, now have exposure to industrial and other developments as well. So it gives more of a broader diversification for those past investors, while not diluting the current Property Partners Trust investors. Also, I want to throw out one example because I was reading about this, and I know you recently sold Lakeridge Technology Center. You can help me out where that location is, I forget. But you guys got a very good IRR, internal rate of return, on that. So tell me just briefly a little bit about that project, and was that a one-off, or do you see this as a bit of a trend?
I mean, that was an exceptional outcome, certainly. But again, that was a single-story flex office property in Atlanta, in Northwest Atlanta, and that speaks to the types of properties that we own. And while that result was beyond our expectations, it was a group that had put together a fund for single-story flex office space across the Southeast U.S., and they were aggressively bidding, and our underwriting suggested that, hey, at that price we ought to be sellers. And given our general pivot within Property Partners Trust to more multifamily and industrial, the ability to profitably trade out of one of our office assets made sense for us. But yeah, we did achieve a very strong result for the fund. It generated about a 27% IRR, and we certainly hope to be able to dispose of a few more office properties over the coming 12 to 18 months and do so profitably and be able to redeploy those proceeds.
And of course, as you get those returns on individual projects, that trickles down into the annualized return for the investors. And speaking about really good returns, I mean, we've talked about industrial, we've talked about office buildings. You had another project in Atlanta called Star Metals Residences. This was a residential, I believe, a residential development, and recently got bought out. I don't know if you can say the name, but a very well-known family office in the United States, institutional family office, purchased this. And again, fantastic results. If I'm not mistaken, it was a record number for Atlanta. Maybe you can talk to a little bit about the Star Metals project.
Sure. Yeah. I mean, to be honest, that was an asset that we'd anticipated that we would build with our development partner and continue to hold for, some as to be determined time. But, such was the strength of demand for multifamily assets that we received expressions of interest at values that, again, made it really, really hard for us to justify continuing to hold that asset. And yes, certainly the ultimate purchaser is a very prominent name in today's technology world, and the value to that investor is ultimately tying the building into a broader network of properties, and they've got quite a unique management strategy that they're deploying across that portfolio. So for us, it didn't make sense to continue to hold that one asset, given the price that was being offered, and so we traded out. And again, a high 20% IRR for us on that project as well. And we actually just received those proceeds a few weeks ago, and we're actively looking at a number of opportunities to get those proceeds redeployed.
Excellent. Well, there's three really good examples: industrial, office space, and residential. And again, the ability to utilize investors' capital to purchase, build, add value, and then exit when appropriate. Speaking of investors' capital, I just want to touch on this briefly. John, I often will say to our clients, we like to work with companies who are institutional grade or institutional quality in terms of investments, as opposed to throw your money at a limited partnership that a couple of guys got together and might take off to Tahiti with your money tomorrow. You actually attract a lot of institutional capital. Can you speak a little bit? Maybe you can mention names, maybe you can't, but tell me a little bit about the degree or percentage of capital you raise from institutions.
Ultimately our investor base includes everything from, retail investors in Canada investing $5,000 at a time to institutions who manage pensions and everything in between. It's certainly an important part of our business. Those investors are more uniquely project focused rather than fund focused, and we allow, through our platform, investors the opportunity to invest with us not only in Property Partners Trust, but in a small grouping of projects or in individual projects, again depending on the quantum of investment. But institutional investors for us are an important source of growth for our firm, and provides investors in Property Partners Trust with the knowledge that they're investing alongside of some of Canada's biggest institutions, and the scale and quality of projects in which they're investing is reflective of that as well. So ultimately, I think it's of great benefit to Property Partners Trust investors. Yeah,
to me, that's a critical thing, because I always like to emphasize when a company that we're working with is also attracting institutional capital, it means there's been a lot of due diligence that's gone in before some of these institutions will ever consider investing $1 with a company like ICM. Now, wrapping up here, John, two things. First of all, every investment has risks. Obviously, and especially when you're exposed to development, there's the potential for risk, and we certainly had those concerns back in March 2020 we talked about. When you're looking from today moving forward, what would you say are some of the biggest headwinds that you're afraid of, or things that keep you up at night, or risks that could potentially derail your best intentions?
Yeah, I think there's a number out there at any given point in time, and right now, I would say that we're in an ultra low interest rate environment, and asset pricing and in desirable asset classes reflects that, and that's true of not only property but the stock market more broadly, and really all other asset classes. And what that ultimately means is that cap rates are at very, very low levels, and future returns are going to be harder to come by in a rising interest rate environment, which hopefully we're entering into, which signals that that we're in a growth environment again. It is going to be more challenging to generate the same level of returns as historically have been available, simply because of the starting point, so to speak. So that's something that we need to be conscious of. We need to really be conscious of the assumptions we're making on the tail end of projects with respect to the exit cap rate, or the valuation at which we trade out of a property. And we are applying much less future growth potential, if you will, to assets from cap rate compression. And in fact, we're underwriting at cap rates that are higher than where we're at today for disposition. But at the end of the day, we do believe that there's substantial growth coming, and in rents in particular, and that will offset some of the pressures that we anticipate experiencing over the next 18 to 24 months. So.
Well, and I think that leads right into my next question, because before I jump into that, I think one of the things you mentioned was higher interest rates, an area we have not touched on. I'm running out of time here, but you also have a high yield mortgage lending component, which is part of what helps you pay out the monthly distribution. So that's going to benefit from an increasing interest rate environment. The other question, and wrap up with this, looking through the same lens, we talked about the risks. Where do you see the greatest opportunities, and what gets you excited about the upcoming years for ICM?
Yeah, where we see opportunity right now is as we've talked about, in both industrial as well as residential property types. We still believe that there's a meaningful amount of demand coming for those types of assets, and the ability to build into that coming demand is where we see a lot of opportunity. Where we don't see opportunity right now is buying existing in-place assets, simply because they're trading at values that are historic highs, and it's really difficult to justify an investment when cap rates are where they are. So we intend for the next 18-24 months to be delivering new product to market, and then either crystallizing gains and through the disposition of assets, or refinancing properties and redeploying capital. And that's ultimately what you'll see from us.
That's fantastic. Well, John, I really want to thank you. I don't know, is there anything else you'd like to share with potential investors before we sign off?
No, I appreciate everybody's time, and take a look at Property Partners Trust. We think it's a great solution for investors broadly. We're professional real estate investors. There's no sense you trying to pick a market or a property type. Let us do that for you. Yeah,
and especially the fact that it's diversifying outside of Canada into the United States and Mexico, and picking up on one of the hottest markets. According to PricewaterhouseCoopers, the hottest component in real estate investing is the industrial space, which you guys are really capturing. I think you're doing a great job, and we're looking forward to working with you. Folks, that's it for Investment Matters today. If you'd like more information, send me an email to peter@peterkinch.com or peter@diversify.ca, and we're happy to help answer all your questions. John, thanks again. It's a pleasure having you on the show, and we look forward to talking to you again soon.
Thanks, Peter.